There are brave traders and old traders, but there aren't many old, bold traders. Many believe that greater risks equate to greater benefits, and more accounts in trading are destroyed by that belief than by anything else. Win more when you swing harder. We're wired that way. And when it comes to trading, that belief damages more accounts than poor timing, poor analysis, emotional choices, and everything else put together. Let's talk about why the aggressive strategy feels correct but doesn't work every time. True tales of traders who had to learn this the hard way, the psychological trap that causes you to double down when you ought to take a step back. And what really sets the victors apart from everyone else? Let's begin with the issue that causes the majority of traders to fail in their first year. You've heard it before. Just 1% to 2% of each trade is at risk. Yeah, but that's for people who are scared, you most likely thought. The real reason I'm here is to make money. To be safe, I didn't start trading. I understand. It sounds dull. You seem to be leaving money on the table. The issue with aggressive trading is as follows. A bad week completely ruins you if you're taking significant risks, let's say 10% each trade, because you're convicted. You've lost nearly half of your account after 5 consecutive losses. You're sitting there looking at a half-cut balance. Furthermore, the psychological harm outweighs the pecuniary harm. You are no longer considering earning money. You're not searching for chances. You're considering returning to your starting point. And that's a whole other mental game with entirely distinct feelings. 5 losses hardly affect the safe trader who risked 1% on each trade. They have decreased by 5%. They may be irritated and even frustrated, but they are not in a difficult situation. They continue to play offensively while searching for the next effective setup. A single trader is attempting to endure. The other is still attempting to prevail. That's the whole difference. Here's what exacerbates the situation. A 100% gain is necessary to recover from a 50% loss. To break even, the remaining amount must be doubled. 5% is lost by the safe trader. To recover, they require a 5% gain. A miracle is required for one trader. The other needs a good week. Because Jesse Livermore's experience exemplifies what happens when position sizing goes wrong, allow me to tell you about him. Livermore rose to fame in 1929. He made almost $1.5 billion in today's currency by shorting the market just prior to the crisis. Consider that. He was among the world's most well-known dealers. He was the subject of articles. Every move he made was observed by other merchants. He was the one who discovered the solution. He filed for bankruptcy 5 years later. How on earth does that occur? In 5 years, how do you go from practically being a billionaire to being broke? His posture sizing became careless. When he was certain about a trade, he began to take large positions. He mistook being on a winning streak for being unbeatable, began to believe that he was no longer subject to the rules. He was severely humbled by the market and ultimately lost everything, not just once, but several times throughout his lifetime. He wrote something that still haunts me before he passed away. I've failed in life. Take a moment to consider that. Due to his inability to resist placing excessive bets, the man who once had enough money to move entire markets and made more money in a single deal than most individuals see in a lifetime passed away penniless. That is not an issue with strategy. The issue is not one of market analysis. It's a survival issue. Additionally, the same issue kills retail traders on a daily basis. What occurs when you trade aggressively is as follows. This is significant because it clarifies why intelligent people consistently make the same errors. You take enormous chances and succeed. Dopamine floods your brain. It feels amazing. You think you're a genius. You have a sense of invincibility. You want to experience that emotion once more. Thus, you get even bigger on the subsequent deal. Why wouldn't you? You simply demonstrated your ability to succeed. After that, you lose. Furthermore, losing is far more painful than winning. This is more than a proverb. It's real neuroscience. The psychological anguish of losing is almost twice as intense as the joy of a comparable victory. Now that you're in a difficult situation, your brain is yelling at you to get it back right away. You are unable to think clearly. You're not able to wait. All you have to do is return to equilibrium. In an attempt to recover in 1 or 2 deals, you scale up even more. We refer to this as revenge trading. In fact, that's how the majority of accounts expire. Not due to poor strategy, not due to inadequate analysis, not due to emotional choices motivated by excessively huge position sizes. You can escape this whole mental nightmare by investing safely. Your emotional reaction is subdued when you're just risking 1% per trade. A loss is not catastrophic, just unpleasant. You're not going to spiral. While a victory is pleasant, you shouldn't get drunk on it and make poor choices in your next deal. You maintain your composure. You maintain your composure. Furthermore, reason is basically everything when it comes to trading. Your feelings influence every choice you make, yet the market doesn't give a damn. Two of the individuals I knew began trading at about the same time. They both started with $25,000. They both practiced on the same simulators, read the same books, and watched the same YouTube videos. They were both fairly good at spotting setups. They were the same trader on paper. It desired quick results. He saw trading as his way out because he was sick of his work and the grind. He wanted to make it happen, so he took a 5% risk on each trade. To make the time he was investing worthwhile, he needed more victories. His account had dropped to $8,400 after 6 months. He was on the verge of total collapse during one particularly difficult month. He was constantly under stress and had trouble falling asleep. His girlfriend saw that he continually checked his phone and seemed tense. His whole life was being consumed by trading, and not in a healthy manner. Trader B adopted an alternative strategy. 1.5% of each trade was at risk. It was borrowing money, according to Trader A, who claimed that trading that little would never get him anywhere. However, Trader B was unconcerned. He didn't detest his day job, and all he was concerned with was consistency. After 6 months, Trader B had $31,200 in his account. Nothing particularly noteworthy occurred. No significant victories to take screenshots of, just regular, uninteresting growth. No big days. But this is what counts most. Every night, Trader B slept soundly. His worst drawdown at about 11% was hardly apparent. There were a few difficult weeks, but nothing that kept him up at night. The account of Trader A was reduced by more than half twice. His connection deteriorated. He yelled at his children for no apparent reason. He was consuming more alcohol. His life was not being improved by trading, it was ruining it. Trader A resigned a year later, told everyone that trading was likely a fraud and that it was too risky and unpleasant. Convinced himself that retail traders were the target of market manipulation. 5 years later, Trader B is still trading with a 6-figure account. He didn't quit his day job until he had enough money in his trading account to feel secure. The same approach, the same market, the same initial investment, the size of the position, and entirely different lives. When COVID hits in March 2020, markets go really crazy. I'm referring to pandemonium. Stocks can move 20%, 30%, or even 40% in a single day. Circuit breakers are activated. The market's fear indicator, the VIX, surged to levels not seen since 2008. You could lose 30 or 40% of your whole account, not just your position, in a matter of hours if you were risking 10% of your account for each trade, and you were on the losing side of one of those moves. Because the volatility was killing people, stops were being blown through and slippage was crazy. I saw it take place. Because the market was moving too quickly, people who believed they had strict risk management suddenly found that their positions were going well beyond their stops. Traders risking 1% per trade. They were also hit. Don't misunderstand me. However, a 3% account hit results from a 30% move against a 1% position. Painful, but you're still in the game. This is where it becomes extremely brutal. The duration of that crash was only a month or perhaps 6 weeks. The markets then began to rebound, and they did so quickly. The prospects on the way back up were amazing if you made it through the initial decline. During the recovery, the safe traders prospered and survived. Some of them had their best months ever. The aggressive traders were already out, sitting on the sidelines with blown accounts, watching everyone else get rich, trying to figure out how to save up enough money to get back in. Volatility doesn't care how confident you are. The quality of your analysis is irrelevant. It just eats aggressive position sizes for breakfast. Are you curious about the risk associated with each trade made by actual experienced traders? The ones in charge of billions and millions of dollars. The average risk per position is between 0.5% and 2%. That's all. The extremely prosperous prop trading companies and hedge funds. On individual positions, some of them are as low as 0.25%. Give that some thought. These are people with entire research teams, advanced algorithms, real-time data feeds, decades of experience, and access to information retail traders will never see. and they're playing it safe. Why? Because they've discovered something that retail merchants won't acknowledge. Staying in the game is more crucial than any particular trade. Survival is the prerequisite for success. Paul Tudor Jones has been absolutely smashing it since the 1980s, among the best dealers in existence. According to his rule, there is a very easy way to get out of a losing position that is causing you discomfort. Leave. That is only effective if you are not afraid of your positions. Every single position is terrifying when you're risking 10% on each transaction. Each loss is painful, so you can't cut losses soon. This is how minor losses become accounting catastrophes. You hold and hope. This is something that is not sufficiently discussed. It is in fact one of the most crucial ideas in trading. You lose time in addition to money when you suffer a significant loss. And the one resource that you can never get back is time. Let's say you lose half of your account. It takes years, literal years of your life, to get back to where you started, even if you're truly skilled at trading and generating steady returns. You recover in months if you lose 10% of your account. However, the price is considerably more profound. You are not compounding for each month you spend recuperating from a significant loss. A month when you're not making any money, an opportunity cost of 1 month. If your account balloons and it takes you 2 years to recover, you lost more than just 2 years. You missed out on 2 years of market chances, 2 years of compound growth, and 2 years that you could have been accumulating true wealth. Time is the one thing you absolutely need to generate wealth, and aggressive trading robs you of it. Years of steady compounding are required. When possibilities arise, you must be in a market with capital. Most people don't have decades to keep starting over after a significant setback. What about those huge victories, though? What happens if I catch a runner and I win the trade 10-1? This is something I always hear. It serves as the primary justification for aggressive scaling. And I understand. It's alluring. Take a 1% chance and make a 10-1 transaction. On your account, you earn 10%. Good victory. You can make 100% on the same deal by taking a 10% risk. In a single trade, you double your money. That sounds much better, doesn't it? But this is the truth. You'll never succeed in that trade. Even the finest traders will have losses along the way, and before you see that 10-1 winner, your account will have been completely wiped. Consider it. You may need to make hundreds or even thousands of deals in order to have the chance to snag that huge winner. You will have losing streaks along the way. Everybody does. It's merely a component of trade. A typical losing run closes your account before you have a chance to make that huge profit if you are risking 10% on each trade. Because those runners do occur, safe dealing keeps you in the game long enough to really catch them, but only if you live long enough to make the trade in the first place. Before they can profit from the upside, the aggressive trader is mathematically removed from the game. They're trying to get me to witness this in real time. And because everything happens so fast, it's ingrained in my memory. I was in a trade Discord channel with this man. Began with $50,000 and was quite adept at spotting setups. For around 2 months, I was crushing it. Raised his account to $71,000. Then he became arrogant. Began sharing photos of his daily P&L, discussing how he had figured it out, and taking an 8% risk on every transaction because, as he put it, when you know, you know. Then he encountered a difficult situation. 5 straight defeats. It does occur. His balance fell to $45,000. This is the ugly part. In a panic, he began writing on Discord about how he had to return. Began taking a 15% risk on each trade in an effort to recover more quickly. Claimed that he couldn't afford to slowly grind it back. 3 more defeats. The account fell to $26,000. He is now utterly desperate. Began making trades that were not even in line with his plan. 25% of each trade is at risk due to pure emotion. His account was less than $3,000 6 weeks after he peaked at $71,000. After posting one more message about how trading was impossible for retail traders, he vanished from the Discord channel. He was a skilled trader, which is why I occasionally think about him. He had good settings. He made a good analysis. However, once he entered the deadly spiral, all of that was irrelevant. The pattern is this, and I've witnessed it numerous times. Large position sizing causes large losses, which prompts larger position sizing in an attempt to recover, ultimately resulting in catastrophic losses. The spiral of death. It is never entered by safe traders. They are unable to do so because they never experience the initial terrible blow that initiates the panic attack. When you are aware that no trade may harm you, your trade gets better in every way. You're not wishing. You're not in prayer. You're not perspiring while gazing at charts. You can't afford to take the loss. Therefore, you're moving your stop loss. You simply carry out your plan, accept the exchange, handle it as planned, and move on. Every facet of your trade is enhanced by this psychological freedom. You're not hesitating, which makes your entries cleaner. Because you are not emotionally invested, your exits are more acute. You abide by your rules because there is no excuse not to. This is not possible for aggressive traders. They have an excessive amount of emotional attachment to each profession. You can't be impartial when 10% of your account is at stake. You begin to see what you desire to see. You need this trade to succeed, so you move your stop loss. Because you need the dopamine rush and the relief, you leave winners early. They may have a good plan. Although their analysis is sound, their position sizing destroys their psychology. And this is what matters most. Over time, this psychological advantage grows stronger. Your confidence grows with each flawless trade you make. It gets easier the next time you adhere to your guidelines precisely. You're establishing a disciplined record. You are demonstrating to yourself that you are trustworthy. The ambitious trader is developing a history of remorse, hope, and panic. They are perpetuating negative behaviors even when they succeed. The next transaction is stressful because the win was stressful. The cycle never comes to an end. The psychological distance between these two traders grows significantly over the course of months and years. One is composed, self-assured, and reliable. The other is unstable, impetuous, and nervous. The same possibilities, markets, and experiences are quite different. When it comes to investing, Warren Buffett has two rules. The first rule is to never lose money. Rule number 2, always remember the first rule. It sounds easy, almost too easy. However, consider his real performance history. He has more than 70 years of investing experience. During the 2008 financial crisis, when the entire global financial system was collapsing, he suffered his biggest decline and lost around 50% of his high. His drawdowns are usually in the single digits. He isn't attempting to hit home runs every quarter. He's not trying to hit the fences. His goal is to avoid striking out. Additionally, he is able to continue compounding year after year and decade after decade because he never loses. The same holds true for trading. It's not the traders who swing for the fences who become wealthy. They are the ones who participated in the game long enough for compound growth to take effect. Furthermore, compound growth is only effective when you are not continuously pulling yourself out of enormous pitfalls. Here, let's be realistic and pragmatic. No nonsense, no hype. You begin with $10,000, you're a competent trader. Just consistent, nothing noteworthy. Not every motion is being caught by you, you're not a genius. Many trades are missed by you. You suffer some setbacks. You're just an ordinary individual who appreciates risk and has learned to trade. Each trade has a 1% risk. Your account is gradually expanding. You're up 3% in some months. You're up 8% in certain months. There are months when you hardly earn anything. Over time, you're heading upward. However, there are some months when you're somewhat down. In the first year, your account may reach $14,000. Not transformative. You continue to work during the day. You have $20,000 in year 2. It is beginning to feel authentic. You're at $30,000 in year 3. You're listening now. You have $47,000 in year 4. Your pals want to know how you did it. You may earn up to $75,000 in year 5, assuming you had a successful year. These aren't lottery ticket numbers, but genuine wealth is being created, and it will last. You don't feel anxious. You're not sleeping less. Simply said, you are reliable. Use aggressive trading in the same scenario. Most don't reach the second year. In the first year, or possibly the first part of the second, they explode. Those who survive for a longer period of time are typically rebuilding from a blown account and repeatedly learning the same unpleasant lessons. They are worn out, burned out, and certain it doesn't work by year 3 or 4. The safe trader, on the other hand, simply compounds annually. They are creating genuine, long-lasting wealth while everyone else is beginning again. It's not thrilling. There are no YouTube videos with the title, "I made $47 this week, trading boring." However, it is effective. And because it is sustainable, it is effective. Every time you blow up and have to rebuild, you miss the best opportunities in the market. Think about the COVID recovery. Think about the AI boom of 2023. Think about whatever the next big thing will be. Those moments happen whether you're in the market or not, but you only profit from them if you're actually in the game with capital. When you're sitting on the sidelines broke, trying to save up enough money to fund another trading account. Those opportunities pass you by. I watch traders blow up 3 or 4 accounts over 5 years, constantly restarting, constantly rebuilding, constantly missing the big moves because they're out of the market. If they had traded safely from the start, they'd be sitting on life-changing money right now. Rather, they have returned to their starting point. Or worse, resentful, cynical, and persuaded that trading is a fraud, informing everyone that it is ineffective. It's not that trading is ineffective, though. It's that trading aggressively is ineffective. Those who regularly show up with bags of cash and a dream are rewarded by the game, not those who show up infrequently. Opportunities in the market don't wait for you to rebuild. They occur when you're sitting outside with no money and trying to figure out how to get back in. And by the time you're back in a market, the opportunity is gone. Marcus, the man who eventually gained knowledge, is intelligent, analytical, and an engineer. Everything you would want in a trader. He began trading with his entire fund of $75,000. Additionally, because he was analytical, he believed that by taking greater risks on each trade, he could maximize his profits. He risked 7% on each trade throughout the first 6 months. Earned a little cash. It felt wonderful. Raised his account to $91,000. Began to consider leaving his position. Began informing his wife that this might be the end. Then he was struck in the face by reality. One poor month. In fact, I lost everything and more during a terrible 3 weeks. The account fell to $54,000. He was heartbroken. It was unbelievable, reviewed each trade, determined what went wrong. In actuality, his approach,